Happy holidays and welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. The most stable and proven real estate asset is the single-family rental home. Today, we'll share some observations and tips from the IMN 11th Annual Single Family Rental Forum, which took place in Scottsdale, and two awesome guests on the Real Estate Guys radio program.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. There are so many different types of folks that invest in real estate, but if we were to put it into two categories, I would say that there are mom and pop individual investors, folks like you and me that own rental homes or small retail centers or commercial buildings. And then there's institutional investors. Those could be real estate investment trusts or insurance companies or a holding company that is more professional, more corporate, if you will. And there's all kinds of in between. Some syndicators, for example, could be considered large personal investors or small kind of corporate investors. And the same thing for family offices. But the reason I bring that up is we're seeing a shift in the landscape about who is owning what in America. About 7 or 8 years ago, I attended my first single-family rental forum event that IMN puts on twice a year. They do one in the East, usually in Miami, one in the West, in Phoenix. Just got back from the 11th Annual Single-Family Rental Forum West, and a lot has changed. So to help us digest all that's happening, we've got a couple of awesome guests, listeners, and students of the Real Estate Guys that were there at the event. First, welcome back to the Real Estate Guys radio program, our friend Sep Bacom. Hey, Sep.
Hey, Robert. Good to be with you again.
Good to have you here and good to see you at the event. I think we'll have a lot to say because you've attended several of these events, and first-time attendee, but not new to our world. Let's say hi to Logan Rogers. Hey, Logan.
Hey, Robert. How are you today? It's good to be here.
I am great. It's great to have you here. It was great getting to hang out a little bit with you guys. Just to paint the picture on this thing, the folks at IMN do a great job at putting together conferences of all types, but a lot in real estate and mortgages and servicing and those kinds of things. And Sep, I think you've attended this particular event more than any of us. Take us through, if you would, kind of the evolution you've seen from maybe the first time you went to what you saw this past event.
Yeah, so for the first time, and I think that was back in 2015, this event played a big part in me transitioning from multifamily investor to single-family portfolio investor. Back then, a lot of the inventory was still coming from tax auctions, from foreclosure sales. There was a lot of portfolios still coming, kind of trickling down from the banks, and the institutional investors were capitalized. They were ready to buy that. Built for rent wasn't as popular back then. I don't even think it was a term that was even brought up in the conference, if I'm not mistaken. And then just over the years, as the prices were going up and as the distressed inventory decreased nationwide and in the markets that institutional investors focused on, they started turning towards built for rent. So instead of having a development of a bunch of houses and selling them off, they would develop those houses. It could be hundreds of houses on a parcel of land, and they would just keep them as rentals. And that's been popular compared to this last IMN. It seems like a lot of the institutional investors have slowed down on the acquisitions, but just a lot of capital on the sidelines. Still a lot of interest in the space. They're talking about 10-year horizons. So a lot more money coming in and potentially coming in the next couple of years.
I think the first one that I went to, there were maybe 350 people, which is a good sized conference. This event had over 1,800 people. And my observation was kind of the corporatization of the single family home right before our eyes. There were lots of institutional investors there. And there's I think a big difference that people need to understand. And that is, no matter how much we say that you shouldn't get emotional about your real estate, that you should treat it like a business, most mom and pops get emotional about their real estate, and they have a heart for their tenant. And I know this is certainly true for you, Sep. A big part of your mission is to provide clean, safe, affordable housing at the lower end. And yet these corporate folks are just a little different. It's not their money typically, and they absolutely treat it like a business because it's 100% a business to them. There is no real emotion in it. But I also think that we've seen it kind of legitimize the single family home as an asset. Jim Rohn always says that kids should have two bicycles, one to ride and one to rent. And I took that to heart in my real estate investing career. And I think everybody should have a house to live in and at least one house to rent, if not hundreds of them. And yet we've not seen the big corporations and institutions in the single family home space except for about the last decade. And I think one of the big changes is just recognizing this asset class. Warren Buffett famously said years back, if I could buy 200,000 single family houses right now, I would. And there's two things about that statement, as short as it is. One, a guy as smart as Warren Buffett recognizing that a single family home does have some very excellent attributes for investment. But two, the fact that he said if, meaning that he felt he couldn't. And the reason he couldn't is because of the way that the single family home market is structured. It's very fractured. It's very difficult to buy individual homes, especially what we call scattered lot, when the houses are just throughout a neighborhood or neighborhoods or city or cities. They're not together in one place. Now, you mentioned build to rent, and that is a newer phenomenon where folks, typically the same corporate investor we're talking about, recognizes that, gosh, if we need more rental properties, rather than build an apartment building, what if I build a community of either single-family homes or townhouses, or one of the popular styles now are these smaller cottages, and it's built ground up, intended to be a rental property for tenants. And we're seeing a lot of that. Logan, when we were there, that was a whole area that you weren't really familiar with. What was your take on the whole build-to-rent phenomenon?
Well, honestly, I just couldn't believe how big it was. I've heard about it, but I just didn't really know. And the way I kind of understood it is if a single family home and apartments got together and created a crazy child, this is what it would be like. These communities have one entrance, one exit. The entire community is ran by kind of a property manager. They all have the same style. They all have the same feel, but people are paying on average $300 more to have a 300 square foot backyard or a small fenced in backyard, or just to have their own walls without having to share a wall with somebody. And it really changed my mindset of what these institutions are looking for, because before they were all like, okay, we are either a single family institution or we're an apartment institution. But this new asset class is allowing them to come in and be both. And since COVID, so many people are starting to move to outskirting cities or outskirting towns. And these build for rent communities, that's kind of where they thrive, is where they're picking up land a little bit cheaper. And because people have a house, they're willing to, be 5 or 10 miles outside of where their job is, instead of being in that apartment that's right in the city. And so it really changed my mindset of how much money is starting to go into this build for rent asset. I really didn't even think about that much. I thought it was, like I was telling you guys before, I thought it was Terry Kerr's Mid-South home buyers just building you a little house and you could rent it. It's totally a different asset. And I think that's what a lot of these big institutional players are really, really bullish on.
The optics were interesting. I mean, just looking around, there were, I would guess, 80% of the attendees were guys in their 30s and 40s wearing sports jackets, right, or suits. I mean, that's just not the crowd that used to come to single-family investment events. And I think that is part of how we're seeing, we'll call the corporatization, but also the professionalization of the single-family rental. Now, the statistic I think I heard from one of the panels, and just to paint the picture of this conference, there are some general sessions that happen the first day. Everyone's in the same room listening to the same panel of experts. And then there's a lot of breakouts over the next 2 days. So sometimes the three of us were in the same session and sometimes different sessions. Sep, you were on a couple of the panels. In fact, through your participation in this event last year, Steve Glenner, who runs this particular IMN event, had invited us to be on some panels. And this year, you and I were both on the introductory panel, which they did a week before the event in a virtual format. And they called SFR and BFR, Single Family Rental, and Build for Rent 101. So we had some great panelists on that call that were kind of painting the picture for folks that weren't as familiar. And I think that was kind of the starting point, was understanding what's happened in the single family market. But then we went to these various breakouts and heard different things. And I think the statistic I heard was still less than 3% of single family homes are owned by institutions. Is that what you guys heard?
Even less than that. I think it might have been even less than 2, but that number varies.
Yeah. So I think when we first went, there were hardly any. And now we're starting to see them acquire, either build for rent where they can get a whole neighborhood or build a whole neighborhood, or individual homes. And that becomes a little bit of a property management issue. So if you were to buy a 200-unit apartment building, your lender would require that you hired third-party professional management. You're not going to manage a 200-unit apartment building on your own by yourself. You're not going to, run the office. That's not how it works. You've got to have professional management. But in single-family homes, it hasn't been that way. And yet one of the outcroppings of this corporatization is we're seeing now great third-party professional management companies in this business. I talked to a guy who's part of a property manager that has over 50,000 houses in their portfolio. I mean, that's a ton of houses. Sepp, you've dealt a lot with the property management side, and maybe share your thoughts about how the corporations and these big institutions are able to effectively, or maybe not as effectively, manage individual assets like single-family homes.
Yeah, they often get vilified as far as when I talk to friends that are looking to buy a home, for example, they say, oh, everything is so expensive and it's because all the hedge funds are buying up everything. It's like, no, it's supply and demand. Hedge funds aren't buying houses in San Francisco. They're not buying houses in California. It doesn't cash flow, and it doesn't have the same dynamic as, say, like a Tampa, Florida, or an Atlanta, Georgia, right? But in some markets, yeah, they're making up 25% of the MLS sales. It's not just like any house that's for sale, they want to buy it. The math has to make sense. As they've come into this space, you hear from a lot of other podcasters about how single family bad, multifamily good. And the only way to scale is you got to sell all your houses and buy a multifamily. Yeah, that was true like 15 years ago or maybe 20 years ago, right? There wasn't really these national property management companies. There weren't all these technology platforms to help investors be able to manage at scale. But as these institutional investors have come into the space, they're vertically integrated. They can manage in-house. And a lot of other times, like it just makes more sense for them to hire a third-party property management company. So as they've gotten into the markets and kind of paved the way institutionally, these management companies don't just serve the hedge funds. They also serve the mom and pop investors or syndicators that maybe they don't have $1 billion pension, funding their deals, right? So it's neat that we can kind of, as investors, operators, or syndicators, kind of fly under the wing of those management companies that they do a good job at servicing the hedge funds, but they can also take care of, say, a 50 or 100 house portfolio as well.
We're talking about the single family market and specifically the corporatization. We've got some great takeaways that are going to benefit you, whether you're an individual investor, a syndicator, or you work for one of these big companies. Our guests are Sepp McCom and Logan Rogers. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Forbes rated Memphis the best cash flow market in the nation. And our good friend Terry Kerr at Mid-South Home Buyers has been the premier turnkey rental property provider in Memphis for over 13 years. With an A+ rating from the Better Business Bureau, Terry has renovated over 750 houses. Real Estate Guys listeners have snapped up hundreds. Discover what these satisfied investors already know. Mid-South's properties are completely renovated with a 1-year warranty and a lifelong rental guarantee. They're affordable, well-managed, and easy to own. Perfect for beginning investors and veterans alike. Get in on the action. Contact Terry and his team via email at midsouth@realestateguysradio.com. Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've ever dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2024 Goals Retreat, January 12th to 14th in Dallas, Texas. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at goalsretreat.com. Get your life back on track, physically, spiritually, and financially. Attend the 2024 Goals Retreat on the second weekend of the new year. Visit goalsretreat.com to learn more and get on the advanced notice list. This is no dress rehearsal. Live the life you were meant to. Visit goalsretreat.com or call 888-489-7723 extension 18. That's goalsretreat.com.
Hey everybody, it's Ken McElroy, and I'm on with the Real Estate Guys, and I'm very excited to be a guest and a speaker at the Investor Summit coming up. If you haven't signed up, be sure to do so.
Welcome back to the Real Estate Guys radio program, now in our 27th year of broadcast. Next month, we'll be able to say we're in our 28th year of broadcast. We're talking today about the single-family home and its evolution as an investment. Back in the day, you would not be able to maybe sell your house, so you'd keep it and rent it out. And little by little, those accidental landlords became intentional landlords. And today, the single-family home is vying again at the top of the heap. There's lots of single-family homes available. Our guests today, Seth Bacom and Logan Rogers, and I were all at IMN's 11th Annual Single-Family Rental Forum West in Scottsdale just a couple of weeks back. And just some epiphanies and takeaways we want to share with you. But I think maybe to start, Seth, I know you've done some research about the single-family home as an asset and kind of who owns it and the leverage against it. Share that with us.
Sure. So this statistic, I think I first heard from you guys as far as the number of homes in America that are owned free and clear. And that was on Bloomberg this past November 2023. It said about 40% of U.S. homeowners own their homes free and clear. So 40% of them, they're not worried about interest rates going up or down, right? As far as the remaining 60%, so Redfin put out an article back in June 2023, and it was fascinating. It said that those 60% of homes that have mortgages, 91.8% of them have an interest rate less than 6%.
Wow.
82% of those have interest rate less than 5%. 62% have interest rates less than 4%. 23% of those homes have interest rates less than 3%. So those sellers, they're probably not going to sell unless they absolutely have to, unless they have to move. But it doesn't make sense for them to sell. And even if they buy the exact same house next door, pay 2 or 2.5 times the monthly mortgage. So that's part of the inventory constraint. Now, as far as the cost of renting versus buying a house today, and this is something that these institutional investors, the pension funds, the sovereign wealth funds coming into the space, that they see this dynamic as well. This was a chart shared by Jeff Klein, SFR Hub, and it was from John Burns Consulting, the data. And they found that the average starter home in the US is $1,180 more expensive to purchase than to rent. So on average, nationally, to buy a home, to cover, to pay for their insurance, the taxes, cover the cost of roof repairs, maintenance, and all that stuff, it's over $1,100 more expensive to buy than to rent. Again, the benefit of having big and small investors come into the space is that we're able to solve that problem, right? If you can make the house cash flow, you can make it profitable, then it's benefiting the tenant who can't afford, a mortgage payment that's twice as expensive or 3 times as expensive as 2 years ago. And, you're helping the communities with that as well.
Well, it's such a good point because it hasn't always been this way. When I started selling real estate in my 20s, I remember one of the things they taught us was the rent versus buy scenario. And I would be able to sit down with a prospective purchaser, or maybe a couple that was renting, looking to buy, and we would do the rent versus own. And you'd have to take into consideration things like the tax benefits if you buy, the amortization, and so forth. And it was very often the case that it was either really close to even, in which case you'd say rather than send all that money to the landlord, Mr. and Mrs. Johnson, maybe you would want to send that money to the mortgage company and eventually own your own home. That was part of the argument. And then I remember they were times when it was maybe $200 or $300 a month more to own, but you had that benefit of equity over time, not being told when you had to move, all those things. So that benefit cost analysis usually was pretty close. Today, it's not even in the same ballpark. It is absolutely more expensive to buy a comparable house to what you could rent. And for that reason, I think, to your point, Sepp, a lot of people just are either not moving. They might want to move for the typical reasons that maybe their family's growing, or they've made more money so they can afford a nicer neighborhood, or they want to change locations because of school districts, but they're not moving because they have that 4% loan that would go away and they'd have to get an 8% loan, and they run the numbers and go, this would be crazy. So that is part of the big constriction. I heard from several of the panelists that's an issue for them. But they also look at the big picture, which is we are underbuilt in housing stock as a nation. And depending on who you listen to, right? I mean, NAR, the realtors, think that we're 6 or 7 million units underbuilt. The home builders think we're 3 or 4 million units underbuilt. Our friend Danielle DiMartino Booth on the summit said, I think it's only about 1 million. But everybody thinks that we're underbuilt, meaning that the properties that are coming off the market because of deterioration or change of use or whatever it is aren't keeping up with the new demand for housing. And we're seeing this everywhere. It's part of the challenge right now is that we need more properties. So one of the benefits, I think, of seeing these corporations come in, especially with build for rent, is they have the ability and the wherewithal to add 100 or 150 or 200 houses to the mix. What do you think about that, Logan?
Yeah, so if you think of, and the whole time you guys are talking, I'm thinking of what's kind of happening. I was listening to a podcast the other day from a really big news station, and it's not a real estate podcast. It's just strictly a big news station. And they talked about the difference between exactly what you're saying, buying versus renting, but it's targeted at all these middle-aged millennials now, between 25 and 40-ish, somewhere in that age. And right now is when they should be buying their family home. And you think of, what's the American dream? To live in a subdivision, to own a home, have your car. And what they're trying to say in this podcast is it's okay to not do that. Essentially, they're going through all the things that you guys just said, but they're saying we have this mindset as Americans or wherever you are is to think we need to own that house. And if we don't own a house, we're not living up to the standard. They're saying that's okay to not do that. And whether that's right or wrong, that's irrelevant. It's the mindset of that's what's the shift between what's going on between the people that should be buying houses right now are being told you don't have to buy a house. Now you have the hedge fund, and you literally think of it, hedge. What are they doing? They're hedging against the dollar, right? And so what are they doing? They're dumping all this money into single family homes. So we have this shift of the normal buyers, the mom and pops, the people that actually live in the house, they're saying don't buy, rent. And then the hedge funds are saying, we're going to dump all this money into probably one of the safest, I can't say safe. I got in trouble by Russ last time I said safe. Risk adverse assets, right? One of the most risk adverse assets that there are, because we all have to have a place to live. We all have to have a place to stay. We don't need a new piece of tech software that, some of these people are trying to get money for. But we do have to have a roof over our head. So for me, that's what I look at from my investing standpoint is, do I want to be a renter or do I want to be one of the owners?
Before we're done today, we're going to share with you just some bits and pieces of various things we learned, and maybe you'll find some tips and strategies in there. But before we break, let's talk big picture. So there's a lot of concern about interest rates and the constriction of inventory and what the Fed might do, and are we going to see a lowering of interest rates and all that. But why don't you guys share, if you will, just some of your takeaways from the folks that you met in the hallway or in the exhibit hall or on these panels, and where their mindset is in terms of, is it time to buy? Is it time to sell? What are they doing? We'll start with you, Sepp.
Yeah. So I'd say most of them who are working with the lenders at the rates where they are today, right? So if the rates are right now between like 7 to even upwards to like 9.5. And then if you're talking about hard money, it's even higher than that. So negative leverage is definitely a thing. A lot of the lenders for single family, they're willing to lend aggressively on single family rentals. A lot of them even go and lend on properties that are negative cash flow. So the DSCR, the debt service coverage ratio, for example, for commercial assets, typically it's like 1.2.
So just no investor left behind. When a lender looks at making a loan, they're interested in two things. How are you going to pay them back? And what happens if you don't? And one of their risk mitigation strategies is to require that the net operating income of a property is more than enough to make the mortgage payment. So you might think as an investor, well, once I paid all my expenses and I've got my rent coming in and now I've got enough to pay my mortgage payment, hey, if I'm $100 or $200 a month positive, that's great. I'll just get a whole bunch of houses and over time they'll be worth more and the rents will go up. Well, the lender is going to say if the number was 1.2, then you need to have 20% buffer, 20% more net operating income than the mortgage payment. That way they know you're likely to make the payment.
Right. Yeah. And for these single family lenders, those lenders or different lenders, they're willing to get even more aggressive. So instead of requiring the borrowers to have 20% room for cash flow, they're willing to even have the property break even. So they're okay with properties at a 1.0 debt service coverage ratio, or even a 0.9 debt service coverage ratio, 0.8. So essentially, they're willing to loan money on the properties on the purchase or the refinance and a cash out and have it be negative cash flow.
Well, and let's talk about this for a minute, because this negative leverage comment came up a bunch, and it is a real thing, meaning that even institutions are making a decision that they're going to buy something that isn't quite going to wash its own face. They're going to have to incrementally invest. So I want to break a paradigm on that. People say, why would you ever buy a property that is negative cash flow? Well, there are some reasons. Imagine that you were buying a property in a great neighborhood where you thought it had a really good chance of the rents going up over time and the property appreciating, and there were new businesses and industries coming in, and the city or county was rated really high in terms of the Happy Planet Index, and you had net in-migration coming. Everything is working in its favor. But because the market is strong and popular, when you do the math, you might have to feed that property a couple $100s a month. Well, that's negative cash flow or negative leverage. But a couple $100s a month compared to the long-term upside for increase in rent and appreciation is just a way of incrementally investing in the same asset a little more. So that's just a paradigm you have to break. If you're never going to buy something that is negative cash flow, then you're going to leave out a whole bunch of awesome assets that could do really well in your portfolio long term. Now, the other side of the coin is you can't have too many negative cash flow assets. If every house I own is costing me $200 a month, in the long run, 10 years from now, I might be great, but I can only afford so many $200 negative a month houses, right? These institutions can afford more than that. And so some of them are making moves that we might consider not to be as prudent, but because they don't think the same way we do, they have these longer term horizons, they're saying, no, we're going to invest a couple $100 million into this asset, and then we're going to continue to invest another $15,000 a month. That's just the way they view it.
Right. And there's also, I mean, at the conference too, there was a good amount of developers and investors too, where their philosophy is more on the side of like everything has to cash flow. So they don't need to take as much money out of the property. Maybe they're okay with not even doing a cash out and just, having it be a what they call rate and term, where you're just refinancing, say, an expensive hard money loan with a lower interest rate loan and focusing on that side of it. How we're adapting to it is balancing it. As far as we don't have to keep every single property. So if it doesn't make sense, then we'll either sell it. You have to do the numbers, I guess, on an individual situation for each asset. But that was another thing I did notice at this conference more compared to before. A lot of the investors, large and small, were flipping their properties just because the demand is still strong, the supply is still tight. It's more expensive to build houses than it was a year ago, 2 years ago, and so on. I mean, single family rentals have been great with inflation the last couple of years.
Yeah, to that point, we had Jim Shields on the show a couple of weeks back, and he's from Southern Impression Homes, and they are a build-to-rent company. And occasionally, even though their primary market is to sell to investors, occasionally they sell a house on retail because the demand is there and it makes sense for a variety of reasons. So, Logan, before we take our break, give us some of your impressions, big picture stuff in terms of what you heard these folks saying about where they are in the market, where their mindset is at?
Yeah, so people would come up to me and say, "Who are you with?" And I'm like, I'm with my company, Clack Capital. Like I just invest in myself with myself. So it's kind of funny because there is a big change of the people, but it was great to glean all their information because they have the best information out there, you know. And one of the big things that I noted was, you know, I have a lot of friends who saw their parents maybe really struggle in 2008 and lose a house, and they saw prices get so low. And then we started to see the rise through 16, 17, 18. Prices went up and up and up. And a lot of them had houses and they cashed out in 19 and said, well, we'll just wait for the next 2008. And we're at the next, I guess, dip in the market, you would call it. But it's not 2008. It is totally different. And what's brought it on is the rise in the rates. That alone has dropped the prices of the homes, but just a small dip. And so what these big guys are seeing is that if they have cash and they don't have to rely on that rate, they can come in and get that house at the 20% discount that it's at right now. And that's why we're seeing kind of a steady, we're not seeing the huge 2008 dip. And I personally don't think we are. And I don't think that anyone there thought we are either. They thought that the dip that we're seeing right now is the dip. It's pretty much where we're at, and maybe a little bit lower. They didn't really know. They were kind of sitting on the fence, but we're not going to see 2008 prices. We're not going to see that huge drastic decrease in these home prices. And so for the person that's sitting on the sideline, it's kind of a little bit sad if they've been sitting there waiting for a huge price decrease, because I don't think that's going to happen. And these people that have all this heavy money that's sitting on the sideline, they're ready to deploy it and they're going to buy up these houses. And so you're not going to see homes for sale in Phoenix for $80,000. You're just not going to see that kind of stuff. And so that was one of my biggest takeaways is the dip that you're waiting for, it could be right now. And if you want to take advantage of it, go do the best you can, because you can refi later and cash in that 20% discount.
We're talking about the State of the Union for single-family rental homes. We've got Logan Rogers and Seth Pacom with us. We'll be back with some of their takeaways and tips, things that are happening in the market that you ought to know about. And we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
Too many people become victims of frivolous lawsuits and scammers simply because they were unprepared. At Corporate Direct, we use the latest legal tools to help our clients of all sizes create a strategy to protect what is theirs. Asset protection is not only for the wealthy. Our strategies and tools are very affordable and practical. Give us a call at 1-800-600-1760 or go to corporatedirect.com to see how we can help you. That's 1-800-600-1760 for corporatedirect.com.
Hello, this is Dave Lendiger, co-founder of RE/MAX International. You're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program, and happy holidays to you and yours. We're talking today about the state of the single-family rental market, and we're sharing observations from the IMN 11th Annual Single-Family Rental Forum. Before we get back to the conversation with Seth Pacom and Logan Rogers, it's time to play real estate trivia. Your chance to win a prize by knowing the answer to today's real estate trivia question. As soon as you think you know what it might be, send your best guess to trivia@realestateguysradio.com. Trivia realestateguysradio.com. First person that gets it right gets an awesome book called Tax-Free Wealth by our friend Tom Winter Wonderland Wheelwright, certified public accountant. That's yours if you know today's real estate trivia question. Last week on the program, we were talking about year-end strategies for real estate investors. We asked this: name the most disliked state in the United States. Well, according to a study by Zippia, the answer is Illinois, followed by New Jersey, New York, West Virginia, and California. Zippia analyzed data from Gallup, the American Community Survey, and an Instagram poll to come up with the most hated states. By the way, the 5 least hated states: Colorado, Utah, Montana, Idaho, and Minnesota. Here's our real estate trivia question for this week. The animals with the densest fur of any land mammals in the world are native to the Andes Mountains in South America. What are they? Yeah, which are these furry little creatures with the densest fur? If you think you know, or maybe just want to guess, send us an email to trivia@realestateguysradio.com, trivia@realestateguysradio.com. Give us your name, the answer to the question, and your physical mailing address. First person that gets it right gets Tax-Free Wealth by Tom Wheelwright. That's today's real estate trivia question. We've got Logan Rogers and Seth Bacom with us. The three of us were at the IMN Single Family Rental Forum event, the 11th annual event that IMN puts on. If you're interested in what they do, just check out imn.org and you'll see those conferences. This was a big one, about 1,800 people in the desert, and there was a ton going on, and it was really interesting to me just how much people are taking this business seriously. So I think one of the big takeaways, I don't want anyone to misunderstand, we're not saying that the corporatization of the single family home is a bad thing or a good thing. It's just a thing. It's what's happening. To me, on the great side, it legitimizes what we've all known for a long time, which is the single family house is a fabulous investment because somebody else lives in it, makes the mortgage payment, and pays the mortgage off. And then you still own the home. And during that time, if you do it right, they cover all of your expenses. Why wouldn't you want to own, like SEP does, several hundred of those? So there was a ton of panels, mostly panels, not a lot of single speakers, mostly panels with the moderator, 3, 4, 5 folks who had different experience. And I thought maybe we just go through some of the big takeaways. So just anything that you guys encountered, heard, met someone and had a conversation about that you think our listeners might glean some good nuggets from.
Yeah, so one of mine was about scaling, or one of the events that I attended, and there was 5 people up there talking about the different ways that they've scaled. And a lot of it was talking about offsite workers, so virtual assistants from Mexico, from India, from all over the place. And what they really talked about was how important it was. Just because you could go get a VA doesn't mean that's going to be the right fit. You still have to have a great person, and you still have to train them, and you still have to have a system, and you still have to have culture within your company.
Yeah.
And one guy even talked about how they'll have a company meeting and they'll get a lunch and they'll send it to their virtual assistant who is, I think, in Argentina or something like that. And I thought that was really neat because just because there's so much technology out there, and ways that you can manage your own facility or companies, you still have to have that culture and those systems to be a big company. And all those guys that were on those panels, they were huge companies. I mean, they were managing thousands and thousands of homes if they didn't own them themselves, And so that's what one of my biggest takeaways was, is there's still systematic things that you have to do in this because it's still a business. You think you're going to be a real estate investor and you won't have to do anything and it'll all be passive income. Well, it's not true. It's still a system. You still have to have those things in place. And so that was one of my big takeaways.
Yeah, they had several breakouts that were based on the number of units you had, like getting to your first 100, getting from 100 to 500, getting to 1,000. In fact, one of the early mornings, Sep, you ran one of those. You were on the session about scaling up. What were some of the highlights from that?
Yeah, it's fascinating because there's not really one way you can do it, right? When I first came to this conference, I think it was like maybe 4 or 5 houses. And it's like that mastermind concept. You get around investors who have a 0 or 2 zeros or multiple zeros on the number of portfolio. They're that far ahead. and you can learn their ideas. I've seen people who investors who are wholesalers that they end up, once they have a funding source or they get traction, they just start to keep those properties. They're really good at buying one-off houses, and they just start keeping them and they build a portfolio that way. There was one of the investors in one of those the larger discussions, I should say, the 200 plus owner panels, where he just buys portfolios, and he's a syndicator, and he buys them with seller financing. And I've done that a couple of times as well. But his whole thing is, just finding out what is the problem that the seller has. And a lot of times they're elderly and their kids aren't interested in taking the properties and managing them. And they don't want to, the seller doesn't want to, vacate like 50 houses so they can go put it on MLS. They'd rather just sell them as is, and they're open to doing something creative. And, if you do that seller financing, you can mitigate their tax risk and all that. Other times there's sellers that just want to be cashed out. You could buy portfolio that way. So there's a lot of tools to be able to trade. Another thing that was surprising is a lot of the institutional investors, they buy and sell portfolios between each other. So a lot of times they don't even hit the market. So there's nothing wrong with buying them one at a time. That's what we've been doing lately, is just because it's a little bit harder for us to find portfolio numbers make sense. And a lot of them are buying deals from wholesalers as well. So, just at the local level.
One of the sessions I was in was about the technology that folks are using today. And when you think about, technology and single family homes, maybe in the forefront were the short-term rental folks who have to figure out how to allow a tenant, a guest, a person staying for a couple of nights to gain access to the property, and how they maintain the turnover and all that kind of stuff. But there's some interesting things happening there. Did either of you guys have any big epiphanies on technology changes in single family?
Yeah, there was a company that had a security system solution, and there's plenty of other companies that do that. There's Ring, there's Simply Safe, and there's the older companies, the ADTs and all that. But it just comes so far where there's modular solutions where the big risk with single family compared to an apartment complex in lower income neighborhoods is the risk of vandalism, theft, squatters, having the HVAC unit come up and walk away and turn into a Halloween Horror Story. So what these technology providers have done is come up with ways and solutions rather to be able to protect the asset if you don't have an on-site manager. It doesn't make sense to have a security guard on just one house. It might on a build for rent subdivision, but a lot of times those are A-class, not really necessary. But if you're doing scattered investing, like scattered site single family, there's technology solutions where you can have cameras in the houses, you can have sensors, you have alarms. So just like you would for a regular house, to be able to protect it during that vacancy. And that's also a cool benefit too, if you're offering that to the tenants as well.
A bit of talk about AI like there is at every conference these days, but one of the folks had this really interesting interface to screen tenants. And it was essentially an artificial person who could answer almost every question that a potential tenant had. So rather than deploy even a virtual assistant, this was a piece of technology that the folks could either call or be online and either type in or ask verbally questions about, the rent and the security deposit, when can I move in, and utilities. And this AI robot woman could pretty much answer almost any one of those questions. Did you guys see any of that?
Yeah, I saw a few of those breakout sessions as well. And I felt like what that's doing is it's taking out the equation of labor. And so when you go to management, one of your biggest costs is the labor that it takes to answer the calls, to answer the questions. And I don't think AI is going to be fixing toilets anytime soon, but it's sure going to be able to sort through the messages, sort through the tenants, the concerns. And that's a huge saver for these institutions. And so I think that the technology is making it cheaper, more efficient for that institutional money to now come in, because before that apartment complex, it was leverageable. Now they're making these single family homes leverageable.
We're talking today about the corporatization of single family rentals. When we come back, we're going to discuss some things that might benefit you if you're an individual single family home owner. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
All aboard! Registration is open for the Real Estate Guys 22nd Annual Investor Summit. Imagine spending more than a week with like-minded investors, world-class educators, and real-world professionals. Returning in 2024 is the editor of the Gold newsletter, Brian London, real estate developer Beth Clifford, and the rebel capitalist George Gammon. Back with us in 2024, sales legend and best-selling author Tom Hopkins. And joining us live and in person for his 12th Investor Summit, Ken McElroy. Plus 2 brand new faculty members we can't even mention yet, and a lot more. It all begins June 13th in Fort Lauderdale, Florida. Visit investorsummitatc.com to get all the details and reserve your spot. This transformational week is like no conference you've ever attended. Go to investorsummitatc.com and make plans to spend a week with the real estate guys, Ken McElroy, Tom Hopkins, and an all-star faculty on the 22nd annual Investors Summit at Sea.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hey, this is John Asraf, and you are listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Hey, if you ever want to do bigger deals using other people's money, or you want to invest alongside some of these institutional investors and fund managers, come on out to the Secrets of Successful Syndication, our 2-day workshop on putting together bigger deals. It happens twice a year. The next one is the middle of March in Dallas, Texas. You can get all the details at our website at realestateguysradio.com. Under the tab that says Events, we're talking about changes in the single-family marketplace in terms of rentals and who's owning these properties and the way they're approaching it. We've got Sepacom and Logan Rogers with us. And I think in this final segment, guys, let's try to bring it back down to Main Street. What are maybe some of the big things that you saw institutions doing that some of us smaller investors can take advantage of? Let's start with you, Sep.
Well, one of the epiphanies I got from one of the institutional investors were they had asked the audience, how many of you in the audience are doing rental income insurance? That was the first time I've heard of that. I've heard of renter's insurance, which we require, but I haven't heard of rental income insurance. So just doing a little more research on that after the panelist was talking about it. The reason the panelist brought it up is he said that that's something that they were doing on their properties, and that apparently life insurance money is coming into this space as well, not just in terms of lending and equity, but also in the form of, different types of insurance products for single families. I was very surprised to hear that the insurance companies, like the car insurance or the homeowner's insurance that you might pay for your house, like they need to go deploy that capital somewhere. And it used to be in Class A skyscrapers and primary markets. But the panelists had said that they've shifted and they want more diversification because they realize that putting all their eggs in one basket in San Francisco office, for example, is dangerous from an investment standpoint. So they prefer diversification. They like, being in, multiple markets or multiple houses and multiple ways to serve the single family rental class. The rental income insurance was interesting. Also security deposit programs. A lot of tenants, maybe if they're a little bit higher risk and you want to get a double deposit, that they just don't have it. So there's companies that are stepping in and making it so that the tenants can move in without having to put money down. And these companies will pay 2 months, 3 months, maybe even 4 months of security deposit, and the tenant just pays a monthly fee. And the landlord gets that benefit even if the tenant stops paying after a little bit. And hopefully that doesn't happen. The other thing too was just as far as what happens when you have properties that are on a low rate. And I was surprised that was another thing where it's some of the investors are like, if we have a low rate and the house has not been renovated, we're just going to keep it as is. And there's other investors, and we're in this camp too, where it's like, yeah, you have a high rate, but when that tenant moves out and you have to do the make ready, you can only get so much rent. But if there's flippers nearby and there's homeowners, that are buying renovated houses, there's an opportunity to renovate that house. And yeah, you lose the low rate. And if you refinance to a higher rate, the payment goes up. But if you're renovating, then you should be able to get a higher rental amount, and the house becomes more resilient, right? You get the carpet out, you put the LVP in there, you make the kitchen and bathroom look nice. It's going to attract better tenants, make the appraiser happy. So that was interesting too, to see that strategy. Not a right or wrong, but for me, the long run is, wanting to have the houses be more resilient than just try to hold on to the low rate.
Yeah, I think a real practical tip is to look at how these professional corporations approach renovation and what the value proposition is for the tenant. Easy for a single family investor to just take a look at that and kind of borrow some of those ideas. My dad, the godfather of real estate, used to say, you don't have to give natural childbirth to ideas, you can adopt. How about you, Logan? What are some other of the things that maybe you think the listeners might find helpful?
Yeah, so the last conference we went to was the New Orleans Investment Conference, where they talked a lot about precious metals. They were all investors, but some even discouraged real estate, right? And then you go to a conference like this where there's 1,800 people that are super bullish on single family homes. And so you're going to get, no matter where you go, you're going to get different information, right? They could all kind of be in a row, but there's going to be people that believe different things. Well, my biggest takeaway was that we all need a place to live. And I'm just a little guy really trying to protect myself for who knows what's going to come in the future, right? I don't know about Social Security. I don't know about Medicare. I don't know about a retirement plan. I have no idea about any of these things. All I know is we will need a place to live in the future. And that's my hedge, is it's going to be real estate. It's going to be some of these single family homes. And yes, I am going to diversify, but you can get a good loan on a single family house. Literally, the people that your audience is, or it's huge. Everybody needs a house to live in. And so we found a lot of luck in people that are aging out. They are in that situation where they maybe have a portfolio of homes and their kids don't want to take care of them, or maybe it's easier just for them to deal with cash to hand to their kids. And those are the kind of houses that we're looking to buy. And so at every market, there's going to be buyers and sellers. And so it's just going in the market and looking and finding things and being creative, because not every house is going to cash flow. And I don't like to buy non-cash flowing house. I don't want to have to pay for that thing. So that's what my big takeaway was. Go out and look for these houses. Go out and find those sellers. There's always someone who needs to sell for a certain reason. And if you can get it to cash flow, it's a great hedge. It's a great long-term investment. And that was my big takeaway.
And just following up on Logan's point, reminds me of that quote from your father, Bob Helms. He said, anytime, he was investing for 7 different decades, and he saw interest rates as low as, 3%, as high as close to 20%. And he said, anytime the interest rate is a single digit, take it. And I think that's the secret weapon with single family is you have Fannie, Freddie, and FHA willing to do 30-year loans, but you even have banks willing to do 30-year mortgages. You have institutional investors, and they call asset-based lenders, right? Where they just look at the property. They're not underwriting the borrower, looking at pay stubs and all that. And they're offering 30-year fixed mortgages too, right? So let's say if you're in the Peter Schiff or Kiyosaki camp and you expect, housing prices are going to crash and the rates are going to go even higher. The good thing is if you have a property or portfolio of properties and they're at a 30-year fixed, then you're more resilient than, say, like an investor where their loan is coming up for balloon and they have to pay off that loan or refinance when rates are higher or the values are coming down. So I think this is something that's still essential, to Logan's point. And if anything, I think if the economic times get worse, there's probably going to be more demand for single family rentals than not.
That is a great point. And keep in mind, one of the big advantages that single family home investors have on the smaller scale is that we can be quick and nimble. We can exploit those deals where we have don't wanters who need to get out of a situation, and we can keep our ear to the ground. Big thanks to Seth McCom and Logan Rogers for joining us today. Make plans to join all of us in Dallas, Texas for the 2024 Goals Retreat. It's called Create Your Future. Happens the second weekend of the new year. All the details at goalsretreat.com. Big thanks to Steve Glenner and the amazing team at IMN for putting on an excellent event. Until next week, happy holidays. Go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.